Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's check in with Alison Williams. She covers the banks for Bloomberg Intelligence, and one of the big banks is JPMorgan, and they're having their investor day today. Alison, give us, what have you learned from our good friends at JPM today at their investor day?
So I think, the most important thing is they're keeping their long-term 17% target. And then sort of supporting that, they did up their net interest income guidance. We don't think that there's going to be much change to, I guess, the consensus, because I think consensus was already there. So they upped the guidance to reflect fewer cuts, but we already knew that. They also upped their expense guidance. Again, we knew that because they have already flagged that they're going to have a gain from some Visa shares, and they're going to use some of that to pre-fund investment spending, some charitable contributions. And then finally, they did some math walking through capital. So Basel III Endgame is the big question. They looked like they would be short based on the last proposals that we got last July, but Powell has said that we're going to see big changes, and so JPMorgan did some scenario analysis around that, and they feel pretty comfortable, and they're starting to increase their buybacks, and there is a lot more to come if we do get some relief to that proposal.
Alison, the stock is down like 0.5%. Do I take away anything from that in terms of how investors perceive the numbers?
I mean, I would say that we didn't get any big positive surprises, so I think that's what the stock is, telling you. As I said, they upped their net interest income guidance, but consensus was already there. We already knew that there were less Fed rate cuts expected, and so they just kind of guided to that. And then, there were questions around their target, but they were so far above that last year. They're operating at such a high level. And again, consensus is already expecting them to beat that target this year. So no real big surprises. I think the next, new news, if you will, that we will get are the stress tests in June, where JPMorgan said today they actually expect their stress buffer, their requirement to go up. So I think setting that guideline sets them up well to either, meet or surprise positively. And then when we do get those guidelines this summer on Basel III Endgame to see, what the big changes are and if we are going to get some of the relief that everyone basically expects after Powell has made those comments.
Alix, you mentioned the stock's down about 0.5% today, but intraday earlier this morning hit an all-time high.
Oh, fair enough.
It's unbelievable. $585 billion in market cap. Alison, just to refresh our memory, where are we in terms of our discussion of succession for Jamie Dimon? Is that even on the table anymore, or where are we in that?
I think that, they're sending a more and more clear message today, having Dan Pinto sort of walk through some of the opening remarks. I think that, more and more that's really, they've sort of made clear the plan. Jamie has the running joke about the 5 years, although, more recently it seems like he has talked about getting a little bit closer towards that goal. But I think really at these investor days, you see what a strong bench they have on display. We already heard from Marianne Erdos, and we heard from Marianne Lake, who runs a consumer business. And really, the strength in these stories, there's so much positive going on, just continuing to invest for growth, net inflows in the asset management business, building out branches in the consumer business, a lot of positive things going on in the business lines, and again, a strong bench.
Before I let you go, have we learned anything about investment banking, what the IPO looks like, what the M&A market looks like? We're still waiting for that turnaround moment. Any word on that?
So that's, I think, all coming up on the agenda. As I said, just so far we really have just been focusing on the asset and wealth and the consumer side, but I think we'll definitely be digging into the details in that in the next few sessions.
Excellent. All right, Alison Williams, thank you so much. We really appreciate you stepping out and chatting with us. Alison Williams is Bloomberg Intelligence Senior U.S. Banks Analyst. She also covers basically anything that handles money. So
yes,
she's very helpful. Asset
that's
manager, you name it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Monday, I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in finance and economics through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies in 130 industries worldwide. We also take you outside Bloomberg Intelligence and get a look at under the hood and on the street and saying, hey, what are you doing with your money? It is very clear that we're in an everything rally when it comes to metals and when it comes to the equity market. As John Tucker was just saying, adding $12 trillion in value since the S&P bottom back in October. So what's going to disrupt that? I honestly don't have a good answer, but maybe Dana Dioria does. Co-chief investment officer over at Evestnet is standing by. Dana, what stops it?
Hi, thank you for having me. Well, yeah, I mean, we've definitely sort of skidded over to this idea that, the resilience is the name of the game. The markets are doing well. We're seeing breadth. It's not just, obviously the Magnificent Seven. But I mean, there are definitely cracks that could potentially widen and become more of an issue. And one of them, of course, at a high level is just the election coming up and the volatility that's going to be coming into markets as a result of that. I think as the election season heats up, and that's not to say, one winner versus another, there will be definite winners and losers based on how the election pans out. But I think as we head into the election, expect more volatility in markets. And then, of course, jobs, employment obviously is a big one. We're not seeing any real cracks there, but if there were to be, that would be an issue. And growth obviously came in this, last quarter a little lower than expected as well.
Dana, it seems like some of this recent move we've seen off that April kind of weakness was maybe driven by good old-fashioned earnings. What did you take away from the most recent earnings cycle? And again, we have another big name reporting Wednesday after the close with NVIDIA.
Yeah, I mean, earnings has been what's been propping up the economy, right, alongside employment. I think the fact that, we haven't seen the weakness yet on the corporate side. We have seen productivity kind of holding steady. Now, that being said, the market to a large extent, I would say, has been sort of priced for an expectation. So, individually, when you see anybody kind of coming in not at, exactly where it needs to be or beating, they kind of get punished. And I expect that would continue, into next quarter as well. But yeah, earnings have definitely buoyed us for, not even just this last quarter, but in general, if you look back to 2023.
Right, which makes it so hard to then sell, because if you take a look at, say, the EA function on the Bloomberg terminal, and you look at earnings and sales growth quarter on quarter over the next year, it just keeps going up. So it's hard for me to then find the reason to then sell. How do you look at the next 4 quarters?
Yeah, so one of the things I would differentiate, of course, is, size of companies, interest rate, how dependent is that company on going to capital markets, for example, in an environment of higher for longer. For example, small caps tend to be, more interest rate sensitive. If you're going to look individually, just who's able to self-fund versus not. So in an environment that's higher for longer, and as corporate debt starts rolling over, I do think that's one area for, as we're talking about it, to say, okay, this is a place where weakness can come in on the corporate side, because these companies do have to return to capital markets and roll over debt at higher rates than they've needed to in the past, higher rates than, they've needed to in a decade, right? So I do think that's one thing. Now, that being said, I am a proponent of small caps. I just think you have to be able to buy in and hold on, because I think the market has priced in that scenario for them.
Dana, in the fixed income side, how much risk are you suggesting people take? Because we can sit in a 2-year treasury and get 4.83% today. How much credit risk should I be taking out there?
Yeah, I mean, it's a funny thing, right? Suddenly you're getting paid, whereas you weren't for a long time in the fixed income space, and you really don't need to extend that credit. So coming from, a platform that services retail advisors and clients, for a long time, we saw sort of just a stretching on the fixed income side. If you look at that standard 60-40, taking that 40% and really stretching what could be called, a fixed income position, right? A traditional ballast position in that portfolio by pushing into higher and higher, higher yielding, leverage loans, even to an extent dividend payers, because you were looking for some return on that. We're not in that environment anymore. And for the standard investor, I agree with the premise of your question that, yes, it's not to say you should take credit risk, but you don't have the need anymore that you did, in a period of financial repression to really move out on the credit risk to be putting in, perhaps, areas in fixed income on a different place in the capital structure, and areas that are just higher yielding, but also bringing more risk to the portfolio when you already have that big equity stake.
So you said you like small caps, but you got to kind of stomach it. Why do you like small caps?
Yeah, look, I mean, small caps, and if you excise the growthiest, least profitable small caps, which are more like a lotto ticket type payoff structure, then you're living in a world where, they have outperformed over time. Small value in particular has tended to not only outperform, but also to outpace inflation. And so if you look at the standard portfolio that most people are sitting in, they have a ton of the big growth just by virtue of the fact that if they're not indexers, the active managers are not going to stray that far. They can't stray that far to take on that much tracking error. So small caps are a nice diversifier that have paid off over time. Again, if you take out those really low profitability stocks, and that's what you see a lot too around, buy quality small caps, buy the 600, right? Because you can get that diversification benefit, that long run return potential, especially now that there's a cost of capital again. And some of the fundamentals can be reasserting in these, style factors, for example, in these portfolios.
All right, Dana, thanks a lot. Super appreciate it. Dana Dioria joining us, Co-Chief Investment Officer over at Evestnet, joining us from Connecticut. It just feels like it's going to be really hard to change the narrative at this point. I mean, maybe NVIDIA does something, but... Yeah,
maybe NVIDIA does something.
Yeah.
Maybe we hear from the Fed that, I don't know. We hear from the Fed so often, but what could they say at the next meeting that would freak people out? I think the market, they kind of conditioned the market to saying, hey, we're going to hang here for a little bit, but on the margin, we're going to be cutting more likely than not at some point this year. I think that in and of itself, the anticipation of a cut, to me, is almost as good as the cut itself.
Totally, and that's what Mike McKee was saying to Raphael Bostic. He was like, I know you guys don't want to do forward guidance, but aren't you kind of doing forward guidance
right.
By doing all that? Because the market front runs you, and you obviously sidestep that, but nonetheless.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's get to the news item over the weekend and also take a look back at Qatar's economic forum, because a lot of interesting things came out of that last week. Iranian President Ibrahim Raisi died yesterday in a helicopter crash with his foreign minister. That was the news. We want to go to Bobby Ghosh. He's senior editor at Bloomberg News, and he joins us through Zoom. He follows a lot of geopolitical issues along these lines with us. Bobby, where does this leave Iran? What is the instability risk here?
Well, this has never happened in Iran's recent history. No sitting president has ever died. So this is a fork in the road that Iran has never come to before. This regime likes to convey a sense of stability and continuity, but it has not been tested in this manner before. I, for one, don't expect a great deal of instability, because let's remind ourselves, the person who really pulls the strings in Iran is not the president. It is the supreme leader, who is unelected. Ali Khamenei is his name. He sits above the entire government and, frankly, the entire administration. And he calls all the important shots. His policies are the ones that the president and others implement. He hasn't changed. He's old and ill, and quite ill. He's 85 years old. And so there are some concerns about succession there. And there was some thought that President Raisi would be the logical successor to the supreme leader. Now that's off the charts. But there's going to be an election in 50 days. Anytime there is an election, there is always an opportunity, however slim it might be, for other voices to be heard. The regime will try to maintain that continuity by making sure that the new president, whoever he is also a hardliner, just like Raisi. But, this is a black swan event. And the things about black swan events are that you really can't be absolutely certain about what's going to happen next, precisely because it's never happened before.
Bobby, is there any reason to believe the death of the Iranian president will alter in any way Iran's views or actions or policies as it relates to the broader Middle East here? I'm thinking Gaza, Israel, what's happening today?
I wouldn't be optimistic about that. Again, Khamenei is the one whose policies are being implemented. Yep. He's not going to change his mind. He's an old school, dyed-in-the-wool hardliner. He hates Israel. He hates America. And no matter who becomes president, they will basically have to do what Khamenei says. The other joker in the pack is the IRGC, which is the military arm of the Iranian state. They're also very hardline, and they will basically not tolerate a government that is softer towards the West. Mm-hmm. So I don't expect any significant change in foreign policy from the Iranians, no matter who becomes president.
You were also last week at Qatar's Economic Forum. Huge lineup of guests. What were some of the takeaways that you had from that? Like, what should we be keying in on?
Well, interestingly and coincidentally, the number one theme, and this took me by surprise, was geopolitics and instability. I suppose I shouldn't have been surprised because of what's going on in the region, the war in Gaza. Now, look at it from this distance, you might think, well, that's a very localized conflict that's just taking place in Gaza that does not involve the rest of the Middle East. And the price of oil is stable. The governments in the Middle East are all more or less stable. And so they wouldn't be concerned. But actually, there was a lot of concern. We heard from the Prime Minister of Qatar about his concerns about the fact that the ceasefire talks between Hamas and Israel are not going anywhere. We heard from the Prime Minister of Malaysia. We heard from the President of Indonesia. We also heard about the geopolitical uncertainties that are sort of continuing from the conflict in Ukraine with Russia invading Ukraine. We heard from the President of Poland who talked about that. So it was really quite. My perception was that the sessions, look, it was a very well-attended event and all the sessions were very well-attended, but the ones that seemed to capture people's imaginations were around the idea that we are now going through a period of instability because of wars, hot wars between countries and the Cold War between the United States and China and everything else. Everybody's strategy, every company's way of thinking of the world, every government's way of thinking of the world has to be refracted through these lenses of conflict. That was quite striking to me.
Bobby, here's my ignorant question of the day, just from a geography perspective. The Persian Gulf nations are attracting so much capital, and there's so much optimism about many of those, that part of the world there, United Arab Emirates, Qatar, for example. I guess how closely are they kind of thought of from investors' perspective with the Middle East, with what's going on in Israel, Egypt, and Gaza? I mean, are they considered two separate regions? So if I'm thinking about investing in, Qatar, for example, I'm not too concerned about the regional conflicts, or am I?
Well, you would think that, but a lot of international investors outside of the Middle East are not making that distinction. Yeah. And they are, that we've heard recently, for instance, Saudi Arabia. Saudi Arabia is a long way from the war zone. The Saudis have a robust economy. Well, while gas prices are high, a pretty strong economy. They're sitting on a massive, massive war chest. They're building these gigantic projects, a whole new city in the desert, and they're open for business. They want foreign investors to come, and you'd think foreign investors would want to get in on the ground floor in a lot of those projects. Not happening. Mm-hmm. Not happening. The Saudi, as RBN Bloomberg News colleagues have reported, they're really struggling to get foreign investors. And some of that is to do with the larger geopolitical instability in the region. Some of it is specifically to do with events in Saudi Arabia.
When we take a look at geopolitics, how we're very obviously U.S. centric because we're in the middle of New York, right? How interested is the rest of the world in the 2024 presidential election? Like, how did the Biden-Trump scenario play out in Qatar?
Oh, yeah. Every conversation I had, bar none, every conversation with every delegate, all wanted to know, oh, you're from New York. What's going on with the election? Is Biden really going to win? Is Trump really going to win? There was some attempt to, we heard from Ken Griffin, for instance, on the stage, who said that, who gave the impression that it wouldn't really matter. He seems to favor a Trump presidency, a return of Trump. But there were some attempts from stage from various speakers to say, oh, the U.S. economy is robust and it doesn't matter. That is not how it was reflected in my private conversations with people off the stage. A lot of it was really, really deep concern. The things that they are seeing from that distance taking place in America are unprecedented. An American former president in court for every day with the possibility of going to jail. There's a lot of concern about that. Would that lead to instability? Would that lead to a repetition of the storming of Congress? There's concern about the age of the candidates, even in a part of the world where leaders tend to be quite old. So that was the backdrop against which all conversations took place.
All right, Bobby, thank you so much for joining us there. Bobby Ghosh, he's a senior editor for Bloomberg News, joining us from New York via Zoom. Busy on the geopolitical front, and we'd like to have access to Bobby and his world view and all of his experience there. Again, the death of the Iranian president over the weekend, and then, of course, the economic forum in Qatar. A lot going on in that part of the world, obviously.
Yeah. And also, I'm sure that LNG played prominently also, just in terms of that being a key product that the U.S. has, as well as Japan and Qatar and the UAE, and then also securing that sort of energy security conversation as well. I'm just so interested, if I'm a CEO of a company, how do you possibly make long-term investment decisions in this political environment, U.S. and globally? Like, how do you do that?
I think well, I don't know. I mean, I think you have to think that these investments are going to outlive the next 4 years, the next whatever,
But when you don't have sanctions and trade restrictions,
true, yeah.
and how do you have?
And they're so different, one side versus the other. Before, there were distinctions between Republicans and Democrats, but like everything else in the world today, those distinctions seem to be more stark these days, and that includes regulatory restrictions tariffs. But now we've got the Biden administration not only maintaining the Trump administration tariffs, but adding new ones, which is something you wouldn't necessarily think
Right. It's
about.
like, how do you deglobalize? How do you deglobalize and also decarbonize and also grow? How do you do all of those three things at once?
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so head over to youtube.com and search Bloomberg Podcast. Commodities. Let's talk the hard commodities, the metals. We'll get to the softs another day, another time. It's all about copper and gold and all that kind of stuff. I don't know what's going on there. Mike McGlone does, because he's been doing this his whole life. He's the senior commodity strategist for Bloomberg Intelligence. He's usually down in South Beach, but we got him up here in New York where the real people work. So, Mike, thanks so much for joining us here. First, I haven't heard about copper in a while. Now it's every day we're hitting new highs. What's going on there?
Yeah, it finally has. There's been some nuances there, but it's the key thing you started off with, the hard commodities, and there's everything else. The hardest commodities are the metals. So let's point out the Bloomberg All Metals Total Return Index is up 20% this year. That just tracks the hard commodities. So copper's a big part of it, but the way I look at copper, it's kind of just catching up to gold in the stock market. It's made a new high. In the U.S., $5.20 a pound, a new high.
What's the ticker I should be using for copper?
HG1.
Okay. All right, I'm on it.
And
that's for
US.
the COMEX versus the LME.
And I knew Alix would go over and point out. You got to point out the LME. It's in metric tons. But since we're Yanks, we'll talk about that. I get confuzzled with both of them. So the key thing I like to point out is what I'm concerned about is it's catching up to the S&P 500 because it has a very high correlation. I remember Alix pointed out once that if you look at those two, they're like tick for tick. But managed money net possessions, like hedge funds, futures, stuff I used to trade and used to watch, they're really long. 32% of open interest. That's the highest since 2021. So they're on top of this trade. They're making money. And it's rare that markets can really stay going up when they're that long already. So the key thing I look at is, and then there's the macro. I look at the U.S. stock market. In some ways, it's very stretched, just versus 100-week moving average is 22%. And then China. Number one thing is China. Just look at bond yields in China. So those two key factors for copper to stay strong in the long term, obviously very bullish copper. But China in decline and the U.S. stock market very expensive means I think these hedge funds are more likely to have to hit their stops on their longs and get stopped out of it at some point.
So a couple of things that you get all that?
I'm stopping out of my copper.
So there's a couple different exchanges, right, that you look at, and that's London, then that's the U.S., and then that's Shanghai. And you can do a lot of arb trades, right, where you can go long one and short the other based on where you think the demand's going to be. And that's kind of what Mike was talking about in terms of there was a short on the U.S. inventories and a long on the Shanghai copper, and then all of a sudden that you got a short squeeze that reversed. And now there's stories about
Let's break this down to
shippers.
what, so normal people can understand this. Doing the bathroom.
I was trying to help you
Doing the
do that.
bathroom.
Okay.
I'm not using a lot of copper. I'm using cross-linked polyethylene tubing.
Well,
So-
actually, that's
PEX.
an excellent
PEX.
point. Because if it gets too expensive, then you're going to see substitutions, right? And that's is the bull thesis for copper as bullish as the bulls say, which is basically like you're going to have endless demand in the energy transition forever.
Javier Blas's column this morning, I forget the title of it, was pointed out that is the problem. And copper is very autocorrelated. It's almost like silver. Silver's earned the reputation as the devil's metal because it only goes down after it goes up. I'm worried about that happening in copper. It's like, okay, you had to hear that first. Yeah. But it's the autocorrelation factor. So I think people are buying into the bullish thesis, and it makes sense in the long term. But for a trader standpoint, when you see these type of nuances where the stock market's really expensive, it's catching up, managed money positions really strong, and China having problems, and by the way, China's the biggest buyer on the planet of gold, it kind of makes me very scared about getting longer copper. Now, I'm very enduringly bullish gold. I mean, gold could correct 10%, it still doesn't matter. The fact is central banks are buying gold, they're not buying copper. The key thing is, that's one thing I've heard, there's rumors that maybe China's hoarding some other metals. Have you heard that, Alex?
I have not heard it, but that doesn't surprise me.
Yeah.
I mean,
it makes sense.
You can make an argument that the U.S. should also be having a strategic reserves of things like nickel and lithium and stuff like that for the energy transition. No, we do not. We have oil.
As far as we know, we don't.
This is true. I'm glad you pointed out Javier's column. So Javier Blas, Bloomberg Opinion columnist, I highly recommend you guys read it. And he was saying that the big distinction between, say, oil and copper is that oil, once you use it, you burn it, it's done. Copper, you use it, if you put it in your pipe for your bathroom or whatever, that's going to be there for a very long time. And you can also then reuse copper too. So it doesn't have the same kind of demand pull, endless demand pull in the same way, even if structurally you are looking at stronger demand because of the energy transition. I found that to be very thought-provoking.
The headline of his article was "Copper's boom story has some truth and much hogwash." And that's what I love is that hogwash. Is when you hear everybody say the same thing. I've heard it so many times. Like, remember crude oil 2 years ago? It was going to 150, and we heard it at $80. You hear it in commodities, got to be very careful. The only one that usually really works in the long term is gold.
And that's what you've been telling us since day one. So, all right, so if I'm trying to come up with a trade here. Copper, I feel like it's technically high. Technicals are driving this thing. So it's just a question, when I see this thing roll over, you short it. Because then
I look at it as a trader, I'd be willing to, I can't say it anymore, but I would structure like a put strategy. I've been thinking that. Right. And so why not? It also, the thing is, it's the trickle down. If copper starts trickling down, it's probably going to be related to this U.S. stock market, related to China. And it's that deflationary trajectory I see. You look at CGBs, Chinese government bond yields at 2.3% versus our 10-year note yield at 4.4%. That's very rare, and that's an indication from a sovereign market of deflationary trends in world's second largest economy.
Well, also, I mean, talking about the trade, just because it may go down doesn't mean it's going to like go to zero. Like,
No.
okay, if it's at like say 10,000 on the LME, you take a little bit of heat off. It's not. It's still not. We're still going to be using it, and there is still a bull thesis. You don't have to necessarily be a crazy bull, though.
Yeah, well, commodity people think trading, right, a lot. So I look at copper very simply. If you're looking at, people look at 4 as kind of the key pivot. Once it broke above $4 a pound, which was at the end of March, it shot up. It was a good technical signal. Now it's like, you just got to be careful with that big thesis of everybody's piling on. That's what I point out from a commodity standpoint. Yes, they were very cheap versus the stock market just a few months ago, and they still are. And I'm hearing a significant allocation towards commodities. But I always like to point out, well, stick with the metals. Bloomberg All Metals Index typically is the best performance over time. Start with gold. And if you're really interested in broader commodities, energy equities typically way outperform things like USO.
All right, let's switch gears to gold, another high. So is this, I mean, you've been saying long gold, short everything else for years and years and years. What's the case for gold here other than, I guess, the Chinese are buying it?
It starts, I think, with the macroeconomic situation. The unlimited friendship shifted the world order. The world's largest buyer of gold right now is China. Central banks, the World Gold Council pointed out that Q1 was the biggest Q1 ever. And their view is it's going to continue. Okay, so that's what matters. But here's put some numbers on. There's been 30 million outflows from gold ETFs in terms of ounces, and about 100 million purchases of ounces from central banks. So what's been significant is the banks are buying, deepest money in pockets who can print dollars are buying gold, and there's issues with China, Russia. But investors like to say in this country is, why buy gold if you get a 5% T-bill in the stock market's on a tear? That to me is going to flip at some point, because we had so much outflows in ETFs. At some point that's going to turn back up, and that to me accelerates the gold rally.
So here's one question with gold though. Just because China keeps buying it doesn't mean they're going to keep buying it.
Exactly. That's why I had lunch with a World Gold Council member last year, and last week, and I always try to pin them down. What's your expectation? Yes, that's the risk they could stop, but it's not just China. Like in the last data, the number one buyer was Turkey. Singapore Monetary Exchange was a big buyer. They're starting to add up, and I think it's part of that kind of run away from the dollar situation to worry about. Like I say, it started with the unlimited friendship.
WTI, $80 a barrel here. What are we doing with gold? I mean, with oil? Sorry.
I think it's more likely, and I've been wrong, but early, maybe, more likely to go to 50 than higher. Because look at WTI. The price right now on this screen was first traded in 2007. And what happens when it goes up? It goes down. Why? Because it creates more supply and demand. So the key fact is, what's pressured crude oil for the last 15 years is the excess of supply to U.S. and Canada. And now we have that building surplus out of OPEC. So to me, it's just about a matter of time it goes lower. So it has also been an example. Natural gas did it. It got too expensive. It got down to low price cure, the lowest price since 1990, and it bounced. I think crude oil's found that trajectory. You have to shut off that excess of supply out of the U.S. And here's key facts. Diesel demand, unleaded gas demand, and containerboard demand in this country are all in recessionary trajectories.
Okay.
We did the container shipping, the container board stuff, box stuff last week.
We did.
We heard that. And yes.
We did hear that. But it also, you're having some refiners open up now after maintenance season, and it is summer driving season. So even if the demand isn't great, you may just continue to see a little bit uptick of demand because we're going to drive more. I don't know. We see.
Because he drives like 17 hours a day, and the Michael Barr. You put those two together.
It should be better for them, but they're going to complain anyway. So there is that. Okay.
And then they have the congestion pricing they have to pay.
Well, that's a whole different bag of chips on that. Hey, Mike, good to see you. Good to see you in studio. Mike McGlone, a Bloomberg Intelligence Senior Commodity Strategist. Always fun to talk to.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So, Alix, you asked if I've ever been in a board meeting. The answer is yes.
Okay.
My famous board meeting discussion is I literally got thrown out by a top 4 media mogul on the planet for valuing his satellite company at what he thought was half the price. We literally got thrown out, escorted out. He didn't pass our fee for like a year.
Wow.
And it was due like the day after.
Good job.
2 years later, sold it for half of what we valued it at.
Half of what you valued it at.
Yeah, so we were wrong, but we were high. But anyway, that was my getting thrown out.
Love this story.
Our next guest describes participating in board meetings as a, quote, punch yourself in the face experience. I've experienced that. Edward Norton joins
Literally.
us. He's a co-founder of Zeck. He joins us live here in our Bloomberg Interactive Broker Studio. No mailing in for this guy. Edward, thank you so much for joining us. Really appreciate it. Talk to us about Zeck. What are you guys trying to do at Zeck?
Well, we're trying to make the experience between management of organizations, and I say that meaning corporations or nonprofits, because obviously we've got a couple million nonprofit organizations in this country that have governance and boards and stuff like that. We're trying to take what we feel is an increasingly toxic dynamic and reform it into being what it's supposed to be, which is a relationship that propels an organization, supports, brings additional leverage positivity to an organization. And we I've definitely had some people say to me, like, you have an interesting day job. Why would you get involved in a...
And your day job, just for folks that on the radio, Edward Norton, actor's been in a bunch of movies and all that kind of stuff.
Yeah. And I will admit that, on the surface, like a software platform for board governance features seems pretty esoteric, but it grew out of my own experiences over the last 30 years, not dissimilar to yours, from serving on the board of arts organizations, serving on conservation organization boards, and then as I built my own companies, and I've built a few software companies that we had our own boards, people like Fred Wilson from Union Square, or Axel or Greylock, or these firms. We were on the management side, and we were experiencing what it meant to have a board. And then when I sold one of my companies and I joined the board of GoFundMe, the company that acquired us,
cool.
I started sitting on corporate boards, and my partners and I really started feeling that there was this elephant in the room, which is that companies go through 4 to 8 times a year. They go pencils down to get ready for this thing that essentially to them feels like a hall monitoring moment. And board members, on the other hand, when I was a board member, 36 hours before the meeting, you get a 90-page PDF, and you're supposed to read it in the airport terminal, and then you go to the meeting and get it read back to you. You know what I mean?
Right,
like there was just, and
so you're looking to make it a more interactive, visual, engaging experience.
I think we say two things. One is, quantitatively, board meetings are an enormous waste of time for everybody, and that has to do with the amount of redundant time waste on setting these meetings up and the presentation materials, and that can be crushed down by having cloud-based, AI-powered tools that make it like 1/10 the time for a company. On Zeck, a company can set up for a board meeting in 1/10 the time that they were using to prep before it. Board members should get to read something that's, you wouldn't read the New York Times or Bloomberg on a PDF. You read it in a mobile friendly scroll, right? That we expect that now. And so everything about the user interface should be easier for both sides of the table. But also think about this. Think about how much time, how many professional, talented people whose time is valuable sit there in board meetings approving minutes approvals, approving stock option packages, things that they ought to be able to do from the airport lounge in advance. So we built governance function that can be interactive and mobile and all of it.
So your customer is the board.
The customer is the company and the board. But both sides, management and board members, suffer in different ways, and we've tried to reform it. But when you crush the redundant inefficiency of time waste, you improve the quality of the meeting too, because a board meeting should be a forward-looking experience, not you don't want to spend hours looking backward. Everybody can ingest the looking backward part before the meeting. You want the meeting to be propulsive and additive to where the company or the organization is trying to go. And the best thing about what people are saying to us is not just, oh, we really love the user interface, it's much easier, it's easier to read. We love that they're saying to us, this has radically improved the quality and the value of the meeting itself and what we're getting out of our board.
So you guys just raised about $7.5 million Series A, led by Salesforce Ventures, including some other guys as well. What are you going to do with it? And what's sort of your end goal here?
Well, I think if you look at, first of all, Salesforce to this day is still, they still are the greatest innovator in cloud-based corporate tools. And I've known Mark Benioff a long time, even though I never told him that we were doing this with his own team until it was done, because I didn't want to, I didn't want it to come from the top down. The Salesforce team is really phenomenal. But, our fantasy was to work with Salesforce because really nobody understands the business of cloud-based corporate tools better than they do, and I also like their ethos as a company. I think they have a great customer service ethos there. But if you look at, think about today, would you ever get a FedEx package with signature tabs on your legal documents? No, you get it in DocuSign now, right? You don't manage your cap table in Excel spreadsheets anymore. You use Carta. And we've made this evolution toward lots of aspects of corporate function have gone into the cloud, but this really critical function hasn't. And we think that on a business level, to be honest, if you look at, Carta, which is a $7 billion private company, and DocuSign is a $15 billion public company, there's an enormous market in relatively low-priced corporate software tools. And we really thought this was a good business. We think there's a very large marketplace of companies and nonprofit orgs that need to reform this critical piece of the
Where are you
function.
in the evolution of the company? Have you signed up clients now?
Oh yeah, we're into the thousands of companies and nonprofit orgs who are our customers.
Interesting, like Fortune 500 companies. What size companies?
Yeah, well, actually, it's funny you say that. We are just in the process of clearing what they call the SOC 2 software security process, and that lets you be a platform for public. We actually have a number of large public companies using it, but we have been mostly for smaller and mid-sized private companies until we clear this critical kind of security.
Do you guys have an end goal here? Because I know with your previous company, CrowdRise, right? That was sold to GoFundMe.
Yeah.
With the same co-founders. Is this the same roadmap for you guys here?
Yeah, I think that we've been totally focused on the product to date, making sure that it really, really works and really gets the kind of response that it's getting. So essentially, we went to Salesforce and said, here's how it works. Here, they loved it, and we said, how do we now sell this? How do we now grow this as a business? And even when we present it like Salesforce's Dreamforce and things, you're talking to a constituency of many tens of thousands of companies. And that's our agenda now. Is we kind of did it in stealth, and as we're doing here with you, we're kind of coming up and out.
And is it a subscription model?
Yeah.
Okay.
It's for any company. For any company that it's incredibly familiar, and if you subscribe to DocuSign, if you subscribe to Carta, you're talking sub $10,000 a year type subscriptions for these tools, and that's why we think, because it has to work for a nonprofit org, it has to work for a small startup company. We're not talking about $100,000 a year enterprise software contracts. We're literally talking under $10,000 a year.
Right. Interesting stuff. Thanks for stopping in. Really
Absolutely,
appreciate it. Edward Norton. He's a co-founder of Zeck. He's also got an acting career, from what I understand. So he's kind of busy out there doing it there. Kind of again bringing. I bet you the pandemic accelerated a lot of that stuff. Like
That's such a good point.
DocuSign and all that stuff.
I don't do anything on PDF.
Oh.
PDFs are dumb on my phone. Of course you're going to want an app.
But you still go to a
through
restaurant and you give them the credit card. They go somewhere. They do it all. They bring you back 17. Whereas you go to, when I'm in Europe somewhere, the little person comes up and puts it on.
The little person comes up and puts on the thing?
I don't know how it works, but the technology.
Who's serving you in Europe?
is everywhere.
Little people, apparently.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.